Ever wondered why people get loans for real estate and business financing with no documents? So I'll break down what's the difference between no doc loans and light doc loans, and finally full doc loans. So let's get started. Number one, no doc loans is a bunch of bullcrap. There is no such thing as no docs. Banks aren't stupid, lenders aren't stupid. Everyone wants to verify and see what you're actually saying. There are some banks out there that will ask for limited docs, but there's no such thing as no doc where you just fill out an application and says, "Hey, give me $100,000 because my business is doing $1 million." We trust you, but we want to verify you. Trust but verify. Take that with you wherever you go in whatever business you do. You always trust but verify the process. So let me tell you how it's worked. Number one, you fill out an application, you're a wholesale business, and you want to have a line of credit or a loan for your business for $100,000. Great, we're excited to work with you and help support your business. However, send us some documentations to show that your business can support that $100,000 loan. Those documentations can be in the form of a few months bank statements, typically 3 to 6 months that the bank want to see and analyze. Also, it could be a tax return that was filed recently. It can also be an internal prepared P&L and balance sheet. So when people tell you that, hey, we got $100,000 just filling out an application, it's not true. One of those documents have to be produced to a bank to get a loan. Even if you go into private MCA world, they want to see bank statements. They want to see your cash flow. So no docs, complete BS. Number two, light documentation. It's really truly one of those things that we just spoke about. Light documentation in the business world could simply mean tax returns or bank statements. Either or, that's what is considered light documentation. And then finally, full documentation is exactly what it sounds like. Typically 2 years business, 2 years personal tax returns, internal documents showing your P&L and balance sheet for the current year, and finally, bank statements to verify what your business is actually doing. Might ask to see financial statements, letters signed by your CPA, accounts receivable, debt schedules, a lot more that goes into play. To get back with the no doc, light doc process, the banks may ask you for limited documentation, but then also they have their own internal systems that they will never let us know what it is that can verify pretty accurately a few transactions that you're doing. So don't get smart about it. Don't think that there are lenders out there that will actually allow you to sign and prepare a document and sign and say, hey, we need this money because we're doing X amount of dollars. Again, it's the trust but verify process. So you may be asking yourself, well, why do some banks or some lenders do no doc, light doc, and then some banks want full doc? It's a great question, and I have the best answer for you. It all depends on the segment that they're serving, really means which industry that they want to work with in the business world, and also their cost of acquisition per customer. Look, some banks have no problem lending you $100,000 to $300,000 with a quick approval. Some banks want to have the full underwriting process. And what's happening in today's world, banks are going with low cost of acquisition. That means that they're giving you the opportunity to get a lending opportunity with them. In return, they're giving you a $100,000 loan, line of credit, a small risk on their books when you're a large money center bank or super regional bank. But in return, they're asking you for your operating balance accounts, means your checking, your savings accounts. They're hoping that you come along with fees. Well, what are those fees? It's not to charge you $20 or $30 monthly fees on your checking accounts. It's to charge you fees that you actually need to run your business. Wires, ACHs, those are things that banks actually make money off of. So keep in mind, yes, they'll lend you the money. They'll make a small spread. Banks don't make a lot on the lending transaction because they're borrowing the money and then they're lending it back out to you. The differential and the spread is their profit margin. Keep in mind, these banks have high costs. They have their real estate that they pay for, their rents that they pay for, their payroll costs. The most expensive people That the people that are actually helping you, it's a cost to the bank. So when you're thinking of the bank's making 6, 7, 8% off of you, they're really not. It's significantly less because they have high overhead. And yes, they're dealing with millions of people, and that's fine. That's their business. But they're providing you with the capital for you in return as a small business owner to make significantly more when used correctly. So a bank does make money off of you on the lending transaction, but they want to tease you with that small lending facility to get you in the door so that they can then make money off of you on the operating relationship where they are able to lend your money out and then make future returns on it. And then finally, fees. They want to charge you fees for services that you have to use. They're not charging you fees just because they want to. Services that you need, they will charge you. And that's why a bank will do a no doc, light doc loan to help you get the foot in the door. Plus, it's supporting your business. Now, let's go into full doc. Banks want to do full doc loans and they want to offer you better products, better services, and a lower cost of capital, but at a larger scale. Meaning that they want to lend you 1 million, 2, 3, whatever it is that you need in lending capacity, but your business has to support it. Vice versa, when you have a small loan, maybe it's just cash flow. Your business can support 100, 200,000. But when you go into the world of borrowing over $1 million, the bank wants to see that you're able to demonstrate responsible borrowing. And what is responsible borrowing? It's predicated on historical data. Banks don't like future. So don't go to a banker and says, hey, I'm going to make $10 million next year. Lend me $2 million to get to 10 million. Bankers can tell you, I hope you do it. Congratulations on starting that dream. Come back to me when it's a reality. Banks want to see historical data. Simple, it's black and white. There's no way around it. And what is historical data? 2 years of prior returns. 2023s, 2024s, we're going into 2026. So they want to see what your 2025 looks like. That could be an internal prepared document, or you have to hire out and get your CPA firm to prepare a P&L and balance sheet signed off by your accountants. Banks are strategic. They make smart decisions and calculated decisions. But when they lend you that money, it gives you the ability to scale your business. So if you're a strategic business owner and you have a banker who's also in line with your business, you have a high success rate. So utilize the bank when used correctly. It can help your business grow with larger scales of lending capacity. So to summarize, light doc, no doc, full doc. Any of those are a great and viable option for your business. Some businesses need it with no docs, some businesses need it with full doc. It all depends on your business, where you're at and where you're going, right? So have your banking institution support you and advise you accordingly. You have any questions, leave it in our comment section below. Reach out to us. We would love to support your business in any type of lending needs possible. Thank you. DIT Capital Advisors out.